Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about GRNY, the Granny Shots ETF from Fundstrat and CIO, Mr. Tom Lee. Now, you've probably seen Tom around, positive guy. A lot of people look at him and say, oh, that's a perma bull, like it's some sort of insult. But I would say he's more perma right. He's been correct more often than he's been wrong, especially since we've been in this bull market. Now, this ETF's just over a year old. It's performed pretty darn well. So today I want to explore this ETF and talk about active versus passive management. And is that little bit of extra expense to invest with a guy like Tom worth it? Let's take a look. If that is what you're looking for, please stick around. Whoop. So GRNY is the Fundstrat Granny Shots US Large Cap ETF, and this is the brainchild of Mr. Tom Lee, who is the CIO over there at Fundstrat. And Tom's on TV all the time. He's willing to come on and give his market predictions, which I appreciate. And in many instances, he's been quite accurate. Now, one area where he's been incorrect this past year has been with cryptocurrencies. So he's made lofty predictions for things like Ethereum and Bitcoin, which have not been accurate. So I'm not here to tell you that he's always right. But I would say that he's on my short list of people to bet with. If you said you're going to give some money to, Tom would be on my short list. I think he's done a great job this past year. And you can see that with this ETF. It's up nearly 20% over the last 12 months. So GRNY, it's closing in on about $4 billion of AUM. It has an expense ratio of 0.75%. So $75 for every $10,000 you invest. And this is what you're paying for if you want a name like Tom on that, right? You're going to have a little bit higher expense ratio. It's one of the impacts that we have when we have an active manager. Now, inception date was 11/6 of 24, so it's only about 13 months old, so relatively new, and obviously a really popular ETF right out of the gate with a lot of people that want to bet with Tom. And we'll take a look at the stock selection process in a minute, but I'll tell you right now that if you're looking for a value-oriented ETF, this isn't really the product for you. This is going to approach it quite differently. You scroll down here, you're going to see this article, for example, that says at 65 times PE, this ETF looks like a ticking time bomb. So you are stepping out a little bit on the risk curve, a little bit more risk, a little bit more reward, hopefully, for taking on that risk, as long as you plan on holding this for a long period of time. So again, a thematic approach that they've got with GRNY that we'll dive into here in a second. If you look at the holdings, just to peruse the top 10 really quickly over here on Seeking Alpha, you'll see that it's a lot of names that you know and trust, maybe a few that you never heard of, like Alphabet, Broadcom, Meta, Monster, Apple, GE, Vernova, PNC, TJX, Quanta, Caterpillar, and only 42 holdings is what they show here on Seeking Alpha. I think they said it ranges between around 30 and 40. This is rebalanced on a quarterly basis, so that will take some of the sting out of it. But a fund that's balanced, but will be a little bit further out on the risk curve. Now, you can have all this at your fingertips yourself, too, if you want to sign up for Seeking Alpha. I am a Seeking Alpha affiliate, and their affiliate links down below. They're having their Black Friday event. So if you're looking for a gift that will keep on giving the whole year long, Clark,
that's the gift that keeps on giving the whole year.
Then check no further than down below and sign up for Seeking Alpha. So now let's take a look at GRNY over here at the Fundstrat website and get a better understanding of how they do their stock selection with their strategy. First of all, what's a granny shot? It's the underhand basketball shot. Simple enough. That's where they got it from. It's not from doing tequila shots or popping grandma on the nose. It's just shooting a basketball. Underhand. So anyway, let's take a look at the strategy and get a better understanding about how we get stocks. Why are we spending 75 basis points on this when we can get an index fund for a lot less? And it boils down to their thematic approach to picking stocks. So in this case, you kind of spell it out here at the top, but it's a top-down approach, which simply means they're going to look at the overall market really broad and look at the overall economy and all the conditions, market conditions, and then narrowing that down to specific sectors and individual stocks so they can find out what they should pick for this. So in this case, they're trying to identify market trends and these themes. So we've got style, tilt, seasonality, PMI recovery, so forth and so on. And the more check marks you get, the more likely you're going to end up in this particular ETF. And if you want more information, again, check out the prospectus. They also have some nicely they've got it spelled out nicely down here below. So they got shorter term themes and longer term themes, so you can read into those as well, but I don't want to bore you with it too much. So that is the top-down approach, and then they have the bottom-up stock selection process. So eventually they're going to narrow it down, in this case, to find large cap US companies primarily that link up with at least two of these different themes to put into this particular ETF. And they aim for around 30 to 35 equally weighted stocks. And we can quickly look at all the holdings for GRNY over here at the Fundstrat Capital website. We're going to see the holdings. If we look at the top, because this is rebalanced on a quarterly basis, we're going to see what's performed the best. And that's been Alphabet, Meta, Broadcom, GE, and Tesla, all the way up to about 2.9%, down around 2.7% of the total fund. As we scroll down, again, because it's rebalanced, we're going to see what's performed maybe not as well, or what has been a real dog. So if we get all the way down to the bottom, we're going to see the true dogs. The ultimate dog in this case has been MicroStrategy, right? Bitcoin has performed very poorly in November and the first part of December. It's dropped off considerably, and that's hit MicroStrategy a lot, so it's down around 2%. Followed by AMD, Netflix, SoFi, Eaton, and GE Aerospace. So come over here, check it out, and you can see all the holdings for yourself. So now let's compare the performance of GRNY in this active strategy versus some passive strategies. And one that pops to mind is SCHD. That comes from Schwab. And that's the large cap growth stock market index ETF. We've talked about it before, but it's a low cost index ETF. So let's see how performance holds up against that, and maybe a few others. But first, a quick word from today's sponsor, which is public.com, about direct indexing. And this is your opportunity, because I'm sure a few of you are out there saying, I can beat Tom. And this is how you can do it. You can build your own index. One of the newest features at public.com is direct indexing. While once a strategy for ultra wealthy investors, advances in technology and zero commission trading have made it more accessible to a broader range of investors. With only $1,000, you can unlock direct indexing at public.com. Direct indexing is an investment strategy where you directly purchase most or all of the individual stocks within a benchmark index, such as the S&P 500, instead of buying a traditional index fund or ETF. This ownership of individual securities gives investors a unique ability to customize their holdings by excluding certain companies. For example, maybe you're someone that wants to tilt their portfolio towards value, growth, or momentum stocks. You can do that with direct indexing. Or perhaps you have a strong belief in ESG practices. You can also do that with direct indexing. So how does this work with public.com? Well, you select the benchmark you want to track, like the S&P 500. Next, you directly buy the stocks of that index while you exclude the stocks that don't fit with your portfolio. Beyond the pure customization and actual stock ownership that direct indexing offers, it also gives you the ability to tax loss harvest. For me, this is the most exciting aspect, because since we have direct ownership of the stocks, we can pick precisely which stocks to tax loss harvest to reduce our overall tax liability. To help investors, public.com also offers backtesting of your chosen portfolio to see how it would have held up in the past, along with tax-aware automation to help spot those tax loss harvesting opportunities. So head over to public.com for more information on direct indexing. And if you're interested in finding more out about public.com and direct indexing, I'll link everything down below. It'll look something like this. I'll try to put that down there. Now, as far as performance, this is only 1 year with GRNY that we have, but I wanted to compare it to some other products that I think kind of fit into this area. Not directly, but should be competitive maybe with GRNY when I look at the holdings that it currently has in the fund. So GRNY is up 19.66% over 1 year. Very short time period, but very impressive performance, up nearly 20%. And I'm comparing that to another active fund here, AOTG. So this is another fund manager that I talked to recently. Hopefully I'll have him on soon, and you can talk about his fund that he has there. Same expense ratio, similar performance, different makeup, different selection criteria for his fund and how he picks them. So that'll be interesting. So like and subscribe if you want to hear more about AOTG in the coming weeks. Our two benchmarks here are, of course, the S&P 500, VOO, up around 14.5% currently over the last year, and the NASDAQ 100 up around 20.5%. And it surprises me. I mean, QQQ continues to perform really well. Buy the Qs, you've done exceptionally well. Best performer out of all of these that I'm comparing it to, up 20.5%. Vanguard has their VGT. This is probably, I include this in a lot of videos. It's probably my largest holding as far as ETFs go. I've been buying this for a long period of time, and I continue to add to it routinely. But this is their information technology ETF, up 20.3%. SCHD, which we kind of discussed. I think this is a good growth ETF that compares to GRNY. I looked at fund overlap a little bit. It was around 50% of what's in GRNY was in SCHD. Of course, SCHD is going to give you a larger stock selection overall. But you can see that GRNY has outperformed SCHD, and so has AOTG, two actively managed funds that I think would compare with SCHD. So it is working in that case, but still lagging behind QQQ. And then I threw in one more, which is QDVO. We've talked about this one recently. This is from Amplify ETFs, and it's up a respectable 18.5%. So another good, strong year for, again, a relatively new fund. So is it working? Is it not working? It's, again, you're stepping on the risk curve. You're getting some good results. I would like to have more information, but off to a really promising start, I guess is how I would categorize it. So that's my first look at GRNY from Tom Lee and Fundstrat. My thought here is that I like that it rebalances on a quarterly basis. I think if we're going to take this thematic approach and you're going to be looking at some of these higher multiple stocks, that would be my preference. I think you have to have a reason if you're going to be investing in an active ETF like that. And that could be as simple as you like the manager's track record, right? You like Tom Lee, you like what he stands for. You're a buyer, you're a believer, because you're going to pay a higher amount to be involved in this, right? It's 75 basis points for this versus if you buy the S&P 500, you're looking at 3 basis points, right? So a 25 multiple of what it is just to own the S&P 500. But we do see performance in year one, in a year where we've had good stock market performance, and we would expect those stocks with those higher multiples to perform probably a little bit better, right? We see more growth out of those. So far, so good. Only 1 year in. But yeah, let me know what you think about this one. Like and subscribe if you like this type of content. Any questions, ask down below. And we'll see you real soon. Take care.